On October 30, the leaders of the world's 20 biggest economies endorsed a global tax agreement. The agreement is to ensure that there is at least a 15% tax on the profits made by large transnational corporations. In July this year, the finance ministers of the Group of 20, commonly known as G20, had agreed on a 15% minimum tax. The G20 formally endorsed this corporate tax on October 30 in Rome. At a meeting of the Organization for Economic Cooperation and Development in early October, 136 countries had agreed to impose a global minimum corporate tax on large multinationals. The countries want to put an end to tax competition that has forced global corporate tax rates to drop over the years. Large multinational corporations have traditionally been taxed based on where they declare their profits rather than where they actually do their business. This allowed several large companies to avoid paying high taxes in the countries where they do most of their business by shifting their profits to low tax jurisdictions. An American company could avoid paying high taxes in the US by declaring its profits as belonging to a subsidiary company in Ireland where tax rates are lower. This practice of profit shifting has affected the tax revenues of governments and has forced them to take an action. The new 15% global tax rate lets the countries impose a top-up tax. Now, if an American company pays only 5% tax on profits through its subsidiary in Ireland, the US government can impose a 10% additional tax on these profits. It is expected to add about $150 billion in additional annual revenues to the budgets of the government. This will prevent companies from trying to avoid taxes by shifting their home to low-tax countries. Many large technology companies carry out a huge share of their business in foreign countries. Thus, many countries have begun to demand a share of their profits. The new agreement ensures that 25% of residual profits are allocated to the relevant foreign country to tax. Residual profit is defined as the profit in excess of 10% of revenue. This is expected to help shift the right to tax profits worth over $125 billion to countries where MNCs actually earn their profits. The tax deal was proposed by the US and is expected to come into force by 2023.